We've been through an era of unprecedented shocks in which our basic framework, the framework we teach in our textbooks, has held up really quite remarkably well. And it's been very encouraging. So we had the crisis of 2008. And then what happened afterwards? We had really unprecedented action on both the fiscal and the monetary side. So the blue line is the annual rate of growth of the monetary base. The red line is showing the budget deficit, which was huge and has now come down a lot, but for a while there was very, very large. Here is one of my favorite quotes. What I liked particularly was that he was saying terrible things were about to happen, then noted that actually they haven't happened so far, but his response was not to say, well, maybe my framework isn't right, but instead to get really annoyed at the economy for not delivering the promised disaster. If you had, however, believed in pretty basic macroeconomics, you would have had something like ISLM in mind. Now, ISLM is kind of unpopular these days for some good reasons. One of them, the Fed targets interest rates, doesn't target the money supply anymore. It never really did, or very briefly did, but it doesn't really make sense to think of the money supply as fixed. Also, some sense that it's an inadequate or a bad model, which I think is wrong. It's not a fully fleshed out model, but it's got a lot of stuff that is useful. But I think it's come back into its own in recent years if you want to think about the central bank not as setting the money supply, which it does not, but as setting the monetary base, which in effect it does. Quantitative easing, which is a terrible term, but quantitative easing, among other things, involves a very large increase in the monetary base, and you want to be able to think about how does that affect the economy? And any kind of model, something ISLM-ish, is going to tell you that there's a qualitative change in behavior when interest rates are close to zero. That you have a normal analysis of monetary and fiscal policy, which is expand the monetary base, interest rates go down, fiscal policy, interest rates go up. That's all going to change when you're close to, I guess can we still say zero lower bound? We've discovered that it's possible for central banks to set interest rates slightly below zero, but not much. That when you're near zero, stuff changes. That if you shift that IS curve back and forth, as long as you don't shift it far enough, you're going to not really have any effect, at least on short-term interest rates, and maybe not on long-term rates. That if you print more money, increase base, all you're doing, an open market operation, is swapping one zero interest asset for another zero interest asset, and it's not really going to do anything. And so the model is interesting because it made predictions that were very much out of sample. Enormous increases in the monetary base, which would not, in fact, expand the economy, at least not much, and would not be inflationary. That you could have very large budget deficits that would have next to no impact on interest rates. So 3 predictions that some of us were making right at the beginning. We're making in late 2008, early 2009, that were very much at odds. So 3 things. One was that even very large increases in the monetary base would not be inflationary. The second, that large deficits would not, in fact, lead to soaring interest rates. The third, which is a little subtler, was that the impacts of changes in fiscal policy, multipliers, would be much larger than historical experience might have suggested. If you looked at history, there is, in fact, in the long run, the classical model does seem to work. That more or less, inflation is proportional to the rate of growth of the money supply over long periods of time. And quite a few people did roll out charts along the lines of this one in 2009 to say, look, this Fed policy is going to be very, very inflationary. It seemed like that was the lessons of history. OK, I'm big on history. Always want to pay attention to the lessons of history. But you need to be you need to think about it and say, are we looking at the right historical comparisons? And if you looked at a more select set of historical comparisons, very few of them, but select, which seemed, based on the model, to correspond to the conditions we were then encountering, you've got a very different story. So this was something I actually put up on my blog in May 2009. Japan had large deficits, continues to run large deficits year after year. And Japan had an early experience of quantitative easing. Theirs was much more simple than ours. They didn't go out and buy exotic assets. They just kind of stuffed the banks with reserves, whether they wanted them or not, in the hope that it would burn a hole in their pockets and get lent out. So if we thought that zero or near zero interest rates were the criteria, and you looked what had happened historically, you could predict, I did predict, that the Fed's dramatic expansion of its balance sheet would not, in fact, be inflationary. So it proved. No unprecedented increase, but because it took place under conditions of near zero interest rates, no inflation at all. And this is the point is not that that I was right. The point is that your basic ISLM was right. It said things that were widely regarded as deeply implausible. I don't know if I can convey just how, it was even in economics departments, you would find people say, I just cannot believe that with the monetary base growing up this rapidly, we won't have inflation. And then if you went to business, if you watched, God help you, if you watched CNBC, or if you talked to people actually in the financial sector, they were all sure that we would have lots of inflation. It was just a widespread conviction that with that much, running the printing presses that fast had to be deeply inflationary. But our basic models, the models we teach our students, said it would not, and the models were right. Budget deficits, huge deficits, interest rates really never budged at all. Let's talk about fiscal multipliers. When we started to have a lot of fiscal policy taking place, there was a quick revival of research. And so the IMF did a kind of landmark study. And what they found was that if you looked at a long historical database of what happened when countries did significant austerity and what seemed to happen to real GDP, the answer is that on average it was in fact contractionary, that austerity measures did lead to a shrinkage of the economy relative to what it would have done otherwise. But the multiplier was fairly low. So they found a multiplier of around 0.5. This study mattered. It mattered actually in two ways. One, I think good, one, I think bad. It did make people aware that austerity measures like those that were being imposed in Europe were likely to be contractionary. But it also led them to believe that the effects would be fairly modest. And that turned out not to be the case. So the Blanchard himself put out a working paper acknowledging that, pointing out that a lot of the errors in IMF forecasts seem to be very strongly correlated with the degree of austerity, roughly that the IMF had assumed a multiplier of around 0.5, and the data actually looked like the multiplier was around 1.3. So I take all of this together, and I say, gee, we came in with a model that was, from the point of view of not just people who don't think about economics, but even people who do think about economics a lot, but don't do textbook-level models. People who read the news, people who feel that they know something about the lessons of history, but don't do this modeling thing. The economists who were doing these little Mickey Mouse models had predictions that were very much at odds with conventional wisdom, very much at odds with what practical people thought would happen. And we're right. It's a lovely, aside from the fact that we're talking about massive policy failure here, but in terms of the predictive success of the models, I think it's been really quite remarkably good. Okay, not everything has gone as one might have expected. There's one thing that I think that I was wrong about, certainly. And not alone, I think, was in believing that the kind of slump that we've had would lead not just to low inflation, but quite likely to actual deflation. We know from some of our models that it ought to be rational expectations of future inflation, but in practice, a lot of people still believe, and I actually still mostly believe that real world doesn't work like that. People signing wage contracts, people setting prices that are going to stay in place for a while, tend to not be doing elaborate model-based expectations and instead tend to be looking at the recent past. And if you believe that, what that says, this is actually an old prediction. It was made back by Milton Friedman and Ned Phillips back in the 60s, was that if you looked at what would be the effect of a prolonged slump on inflation, you would expect to see in a space of unemployment versus the inflation rate, you'd expect to see a sort of clockwise spiral where higher unemployment would bring inflation down, inflation expectations would fall in the light of experience, and eventually you'd be able to get back to the original unemployment rate at a lower rate of inflation. And if you looked at what happened during the last really severe economic slump in the United States, that's exactly what happened. This time, didn't work at all. If you believed that we were going to see the same pattern that we'd seen in previous large slumps, you would have expected us to be well into deflation by now. Instead, you did not. Instead, inflation fell some, but then stayed low without really showing much movement at all, either up or down thereafter. So we've had a long period of low, below target, by the way, but low inflation, but neither acceleration or deceleration. Initially, people, I think the initial reaction was, wait a little while. Then the reaction was, well, maybe we're wrong about potential output. Maybe the natural rate of unemployment really is 8%. But then unemployment has come down to 5, and still nothing happening. The Fed talks a lot about anchored expectations, but that doesn't explain why we haven't seen any rise in inflation with unemployment falling so far. I think, but this is certainly not any kind of consensus view, I think that a lot of it just has to do with when you're very close to zero. Inflation just doesn't want to fall further, that there really is enough actual downward nominal rigidity in the economy and enough noise so that there's always somebody against that inflation really is kind of sticky at very low but positive rates. But in any case, that certainly has not panned out. So that piece you cannot celebrate as a triumph of what we thought before. The inflation risk that everybody who mattered was obsessed with hasn't panned out. The deflation risk some of us were worried about hasn't panned out either. Kind of interesting. This is extremely relevant because if you read Janet Yellen's speech from 2 days ago and her explanation of why the Fed is still ready to raise rates, it's all about inflation dynamics. And the truth is, I think we know a lot less about inflation dynamics than we thought we did. So this is one place where we really have a big problem. But I just want to come back and say that the story, as I see it, is one of we should be feeling pretty happy about the economics we teach, about the macroeconomics we teach. We came in where we have a real-life situation where somebody who actually read the textbook, who actually listened to the lectures, would have been in way better shape than someone who didn't. I have a neighbor in Princeton down the street who was actually a currency trader. And about 2 years ago, I ran into him and he said, it's really amazing. All the experts were saying we were going to have lots of inflation. I started to say, which experts? Well, everybody I saw on CNBC. But the great thing is to be able to say, actually, we're the experts, us college professors. We're the people who actually knew this. And before we only thought it, and had to wonder, if we're so smart, why aren't we rich? But it turns out we actually were smart. Still not rich, but anyway, it has worked. It's been a good time for macroeconomics. We should be feeling pretty good about how textbook macroeconomics has worked in these troubling times. Thanks.